How to view long-term capital gains tax. Long-term capital gains are taxed more favorably than short-term gains. And the treatment depends on your income level, the type of asset, and whether you use any tax deferral strategies. In the US, assets held more than 1 year qualify for long-term rates, which are typically 0%, 15%, or 20%, far lower than ordinary income rates. These are things you need to understand. 1. Know the holding period rule. Anything held 1 year or less is short-term and taxed as ordinary income. 2. Understand the tax brackets. Long-term capital gains are taxed at 0%, 15%, and 20%. Some high-income taxpayers may also owe the 3.8% net investment income tax, NIIT. 3. Account for the type of asset. 4. Use these tax-efficient strategies to treat or manage long-term capital gains. First, tax loss harvesting. Offset gains with realized losses from other investments. Second, tax-advantaged accounts. Holding assets inside IRAs, 401ks, or HSAs can eliminate or defer capital gains taxes. Third, installment sale trusts or other deferral structures. For highly appreciated real estate or businesses, find those that can defer capital gains tax, receive payments over time, reinvest pre-tax dollars and grow them compounding. Fourth, hold for a step-up in basis at death. Heirs receive a stepped-up basis, potentially eliminating capital gains entirely. From these strategies, the 537 installment sale trust can be one of the most effective and efficient ways to treat long-term capital gains because it defers the tax, preserves the entire sales proceeds for reinvestment, and converts a taxable event into a compounding income engine. The 537 IST is effective because it's built on IRS Code Section 453, the same installment sale rules already being used for decades. Instead of receiving the funds directly, which triggers capital gains tax, a special business purpose trust will receive the funds in exchange for a secured promissory note. The trust then sells the asset to the final buyer. The effects are 1. Immediate tax deferral. No capital gains tax is due at the time of sale. The seller pays tax only as payments are received over time. This keeps 100% of the principal working instead of losing 25% to about 50% to taxes upfront. 2. Compounding on pre-dollars. Because the trust can invest the entire sale amount, not the after-tax remainder, the growth will curve dramatically higher. A $3 million sale with a $1 million tax bill becomes $3 million invested, not $2 million. Consistent returns create a massive long-term advantage. 3. The flexible income design. This makes it ideal for retirement income planning and even estate planning. 4. It works for real estate, businesses, and other appreciated assets. 5. It's a safety net for failed or partial 1031 exchanges. If a 1031 falls apart, the 537 IST can step in before escrow closes to keep the gain deferred. We have been setting this up for over 20 years. We can share with you free information on how it is done. Reach out to learn more.